Let's bring in Eric Robertsen. He's back with us. Global Head of Research, Stanchart, live from down Sydney side. Eric, great to see you and appreciate your time. So as far as the jobs report goes, the bar, the threshold seems to be pretty low.
Hi,
a lot of people are joking that, look, as long as it's not zero, we're a go for taper to start November. Do you agree?
Yeah, sure. That's our base case. We think that unless the payroll report is significantly different than expectations, the Fed is on a path to making an announcement about tapering of asset purchases for November. We think those tapering actions would be implemented by the end of the year and into early next year. So again, barring a significant disappointment, I think we're on track.
Let me ask you, as far as the surge in yields go, and we were noting early Asia Friday, we're up at about 158 now. Some of it is pricing in, obviously, taper, the surge in inflation, commodity prices, et cetera. How much of it is also pricing in the risk of a U.S. government default, notwithstanding the fact that we've got a temporary extension now or a temporary upping in the debt ceiling?
It's a good question, Marty. We think there has been some dislocation in U.S. rates, but almost entirely at the front end of the yield curve with regards to Treasury bills. Most of the increase in yields that you describe has been related to an improvement, I think, in the cyclical outlook. We've also had a repricing of Fed rate hikes for 2022 at the end of the year and into 2023. That has lifted yields in the front end of the curve out to 5 years, which has been a key part of our baseline forecast. 10-year yields and 30-year yields have increased, but by less than the front end of the curve. So if you go back to, for example, since the June FOMC, we've seen a pretty good flattening of the yield curve since then, and we would expect that to continue into the end of the year.
You know, Eric, this whole inflation debate here, I want to leave aside whether it's transitory or transitory for longer or how much is being built in structurally, right? And get to the issue much more longer term of whether inflation is actually here to stay or whether we're going to revert to deflation or disinflation. I mean, the arguments on that front have been around for a long time, right? You got technology, you've got demographics arguing against prices going higher. You are looking much more closely at productivity, part of which is tied to technology, right? This is squeezing more out of the same equipment or worker, et cetera. Are there signs that productivity is going to help keep prices, are going to help rein prices in? And I think here we need to look at things like CapEx, right?
Those are certainly great points. Look, the challenge or the complication with the inflation debate is the time frame that you're thinking about. In the short term, we're certainly seeing elevated inflation in a number of countries. We believe a big part of that is due to the supply chain disruptions that we're seeing around the world. A lot of that is due to various reopening challenges, still the lingering effects of COVID. In a variety of the world's manufacturing hubs. We do believe that supply chain disruption will start to ease as we get into next year, and that should put some downward pressure on some of these inflation figures, but we do acknowledge that it does look alarming for the time being. On a more medium to long-term basis, we've seen something interesting, which is emerging signs of much better productivity in some of the major economies. Now, that's a bit different than what you would normally get in a recession and an aftermath. And so in some ways, we see some potential mitigating signs against this inflation narrative. Productivity boost would certainly be helpful. We are seeing a pickup in CapEx in a number of both developed and emerging economies. And I think that will ultimately prove very helpful in this inflation debate. Our base case is still that ultimately we will go back into a disinflationary environment as supply and demand normalizes. But I think that's probably a story for the middle of next year.
Eric, is that improving productivity narrative true for China? And where does it leave the macroeconomic picture, which I've got to say is looking very challenging in 2022? And I've been hearing expectations of 5% growth.
I guess I'll answer your question, Sri, in reverse order. I mean, you're certainly right. There is there are signs of slowing momentum in China's economic growth narrative. We're seeing softness in consumer spending. We've seen that over the holiday period. The real estate challenges that the economy is working its way through, I think, will exert a medium-term downward pressure on the growth narrative. And I think what we're having to accept is that the normalization of growth in China back towards 5 or 5.5% is going to happen a little bit faster, perhaps, than market expectations had been at the start of the year. We've recently taken our growth forecast for 2021 down towards 8.25% from 8.8%. And so we acknowledge that the growth narrative is more challenging. Productivity, look, we've seen very good productivity in some sectors in China's economy, but there are also some sectors, I guess you would call the old manufacturing sectors, the state-owned enterprises, where we still could see plenty of opportunity for a lift or a pickup in productivity that would be supportive. So it's a mixed picture.
When you consider the energy shortages, higher food prices, all these supply chain blockages and labour shortages on top of that, Eric, do you fear that we're looking at a winter of discontent in the coming few months? And if so, where does it put this entire narrative of holiday season demand? Is that going to be left in the dust this year?
One of the things that we've been thinking about over the last couple of weeks is, some of the unintended consequences of these higher commodity markets. In the first half of the year, higher commodity prices were associated with a pickup in the cyclical narrative around the world and generally viewed as a very good sign for the global economy. More recently, I think a lot of these energy price increases, whether it's oil or natural gas, have an element of supply chain challenges. I think that's going to put a damper on consumer spending. Food prices are high as well in a number of places. And so for the average consumer going into the holiday season, when your energy and fuel price bills are soaring, that really does raise the risk of a hit to consumer demand. And I think that's something worth paying attention to as we get into late Q4 and early Q1 of next year.
Right, they are volatile components of the inflation basket, but they are high-frequency purchases, which makes it very challenging, as you said, Eric, for consumers. Eric, thanks for that. We'll get back to you again later on in the programme. Let's get back to Eric Robertsen from Standard Chartered Bank. And Eric, at a corporate and earnings level, how vulnerable would you say margins are in the Q3 earnings season, which is just around the corner next week, actually? And if it does take a bite out of headline earnings growth, then is that going to lead to a broader re-rating of these markets and multiples?
Look, Sri, it's an important question. We've seen a number of what I would describe as major U.S. companies, especially in the consumer and agricultural space, talk about rising input costs. And so the question I think that we want to see answered over the next couple of quarters is how much of those costs are being passed on ultimately to the consumer, or are they being absorbed through a hit to profit margins, as you say? I think it's interesting that even though the U.S. economy does have a relatively large energy industry inside of it, if you look at the S&P 500, for example, the energy sector is 2% of the total market cap for the S&P. And so there's a couple of ways to think about this. One, this surge in energy prices may be very good for these energy companies. That doesn't necessarily mean that it's great for the S&P 500. I think what we want to see is things like the consumer discretionary, consumer staples spaces, and how they respond to this increase in both food and energy prices. That will be the key question for us over the next quarter.
Eric Martin here. Just real quickly before we let you go on this whole question of inflation. And I mean, so far it's mainly to do with the supply side, right? Capacity not coming back fast enough, plus supply chain kinks, we know that. You're worried, though, what happens when demand gets back to pre-COVID levels, plus layer on top of that, what happens with this whole pile of debt that not just China, but also, and probably more conspicuously by the numbers, the U.S. has piled up, and how challenging that could be. Talk us through your thinking.
Sure, Marty. The debt pile has, grown in a fairly exponential fashion over the last 18 months as a result of the COVID related economic crisis. Global debt is now nearly $300 trillion. We've seen a significant increase across both developed and emerging markets, as well as in the corporate space. Debt to GDP levels obviously going higher in a number of key economies. The key question will be, can growth continue to stay resilient? Can growth pick up? Is the cyclical recovery story intact? Because if it is, then debt to GDP ratios will come down by virtue of growth improving. On the other hand, if growth starts to normalize or even experiences some softness, the weight of that debt pile becomes a major headwind for both consumers and corporations. Now, the good news is there is an offset. We've seen consumer balance sheets improve over the last couple of years, largely due to fiscal support. U.S. money market funds still have about $4.5 trillion in assets under management. And so while the debt pile has grown, we've also seen in some ways a significant buildup of what we would call precautionary liquidity. So that tug of war is going to be a critical tension to watch over the next 12 to 18 months as the economy continues to evolve.
Okay, excellent point, and we'll be keeping an eagle eye out. Listen, Eric, great talking to you as always. Great value. Appreciate your time. You keep safe where you are. We'll do it again very, very soon, I hope. Eric Robertsen, Stanchart, joining us live.